Hello and welcome once again to the Capital Spreads Weekly Market View. This week I'm joined by our resident expert Angus Campbell. Thank you very much for joining us, Angus. Obviously it's been a very busy week for both economic and non-economic news. I think the biggest highlight so far has been the hurricane in the US. Sentiments go out to all the people affected. I mean, in terms of financial market view, what's your view in terms of what's actually happened? And has it been as bad as people have been expecting?
Yeah, of course, as you say, huge destruction caused by Hurricane Sandy. And whilst there were some devastating effects, I think that as it hit the East Coast, it had lost most of its power. So the destruction may not have been as bad as it possibly could have been. And so what we're seeing is, at least in some degree, some relief in that respect. And actually the US markets, not that's the only reason why they're rallying today, they are rallying quite significantly now that they're back in full flow after having been closed for 2 days, unheard of, at least hasn't been seen for over 100 years, that due to weather conditions. So very extreme, but I think that generally on the whole, the feeling is that things aren't as bad as they could have been from Hurricane Sandy, and so that is in some way just helping lift the markets at the moment.
It's quite interesting considering just a few weeks ago markets were going absolutely through the floor. Everything looked like it was going to the wall, everything was just like we're going back into a recession. Obviously over the last couple of days we've had that bounce after the market's opening. What's causing this? I mean, what's the cause of the turnaround in sentiment?
Yeah, well, it's certainly not just down to Hurricane Sandy being less bad than it could have been. There has been a slight turnaround and an uptick in economic data. From a technical point of view, if you look at the Dow and you look at the S&P, they've actually found a good support area. They were the sort of support area that we'd previously seen in the indices. For the Dow specifically, that sort of 13,000 area just seems to have lent a bit of support. Now, it doesn't mean that we're going to, definitely for sure head higher. Of course, we don't know where the markets are going to go, but that seems to be a key support area for the Dow in particular at the moment. And as mentioned, there is some good economic data. There's the wonderful non-farm payrolls and that big fall in unemployment in the US that we saw earlier. Here in the UK, we saw GDP bounce far better than expected. Over in the US, GDP much better than expected. I mean, one kind of thinks that with the election literally next week there, the presidential elections, that maybe those numbers have been massaged somewhat. At least the evidence would suggest that anyway. But things just looking slightly better. And just today, we've had some good corporate earnings this week. Today we saw good Chinese manufacturing numbers, and that really has lifted both indices here and in America.
Leads me on to the next question. Actually, you just touched on this. NFP tomorrow, probably the biggest economic figure of the month. What's your reading? What do you expect, and what do you think the markets will do?
Well, markets are expecting 125, just up on last month. If we take today's ADP figure, which isn't quite as sort of focused on as the non-farm payroll, but it's still looked at, that came in far higher today than expectations. So that's encouraging for tomorrow's non-farm payroll. They don't usually match each other at all, but the other thing about the ADP figure is they then revised the previous month downwards. So, but what you're seeing is you're seeing a creation of jobs, and as I mentioned, some of it maybe being massaged a little bit. Strong government job numbers. Is Obama trying to? Of course, he's trying to get re-elected. So, he's trying to help boost those figures. The GDP we've seen improve, the unemployment fall. So, non-farms for tomorrow, market's expecting 125. My personal opinion is that we may see upside to that, but if there is upside, I wouldn't say it's going to be particularly a huge figure, but we could possibly see the unemployment rate tick back up actually just to 7.9.
So do you think the markets could actually tick higher?
The unemployment rate could tick higher to 7.9. The markets, well, who knows? But if you get a good non-farm payroll number, then that could potentially be the next kind of bit of momentum to lift the markets off these levels further.
You've also touched obviously on Obama. Now, obviously that's within less than a week's time from now, and that could totally change the political landscape of the US. We've got the US election in less than a week or so. What's your reading of that? If Obama gets in, if he doesn't get in, how the market's going to interpret this?
Yeah, well, I suppose what we can go with is some historical numbers. I've been doing some number crunching. Obviously, Bill's not here this week. He being a Yankee himself, well, non-resident, but he's probably over there voting or something. I'm not sure, but he'll be back next week to kind of give us some more information with the results. We will know whether we have a new president or whether Obama's still in office. But when you look historically, last 12 US elections, so since the 1960s, you've seen, actually, interestingly, the day after each election, more often than not, will see a decline, or not will, has seen a decline in the S&P 500 index. And if it's a Democratic president that's been voted in, they tend to see more declines than any Republican presidents who've been voted in. So historically, the stats say that no matter who gets in, the markets have fallen in the past. Now, whether that will happen this time round, it's impossible to say because there's so much that's riding on this presidential election. It's very, very close as well. And if you take the polls, they're indicating that it's neck and neck. However, Obama has his head in front in the key sort of swing states. And if he stays in, then that's, I suppose, good for the markets because there's no uncertainty there. You know what you've got. You've got Obama. He's the same. He's just going to do sort of similar things going forward and try and help the middle classes. Whereas if Romney comes in, there's that little bit less certainty regarding what he wants to do in terms of, especially the fiscal cliff, which of course is, the 1st of January, what's going to happen there. So whoever wins is going to have to address that anyway. Yeah. I think what probably is more likely to happen than anything else is an increase in volatility, especially as that fiscal cliff nears.
I think we could certainly do with a bit of volatility right now, given what we've had over the last few months or so.
Well, it's been very quiet, hasn't it? And,
yeah.
Whilst volatility makes for tough trading conditions, it certainly makes for more exciting markets.
Absolutely. Well, we've obviously got a lot to look forward to in the next week or so. Thank you very much again for joining us.
Pleasure.
Thank you very much for watching us. If you have any feedback, as usual, it's media@capitalspreads.com. Thanks again.